Okay, welcome back to Introduction to Financial Services Industry. This section, we're going to do a short video talking about arbitrage. Now, arbitrage is not like a retail concept, and it's something we're not going to spend a lot of time on, but I just wanted to take a few minutes to talk about it so that when the term comes up, that everyone is familiar with it. And again, this is not to offer any financial advice. So the term arbitrage, which comes from a French word, means fair decision. And what in our world, financial services, what this means is the simultaneous purchase and sale. So the purchase and the sale, the buy and the sell of an asset in order to profit from differences in price. Is a trade that profits by exploiting price differences of identical or similar financial instruments on different markets or in different forms. Arbitrage exists as a result of market inefficiencies. It provides a mechanism to ensure prices do not deviate substantially from fair value for long periods. All right, now that being said, this last comment is probably the most important, which is with computers today, there's very few opportunities for arbitrage, especially in the US market where, you could have situations between ECNs where you have shares available on an ECN and available on a several different ECNs or different markets. But those opportunities are very quickly filled by sophisticated computer systems for institutional traders and people doing this seriously. So there are very few opportunities today as compared to years ago before we had such sophisticated computers. Very fast computer systems have eliminated a lot of the arbitrage opportunities. Now, there still is arbitrage taking place in the markets, and we can talk about that a little bit. And I have an example. And I did discuss earlier, if you remember, in one of the videos earlier, talking about American depository receipts, where there are opportunities to arbitrage between the US and Europe on ADRs. So let me give you an example of arbitrage, just so we can explain what we're saying. Where you have an asset and the same asset is traded on different markets, but it has to be the same asset. So we're not talking about a case where the B share is selling for a price less than the A share, or the bond is selling different than the stock. It's the same asset, right? Or it can't be a bond at a different rate compared to a bond at a different rate, or a bond with a different maturity date. When it's the same asset, or in the case of bonds, very, very similar, where it's the same asset offered on different markets, where there's a price difference. The idea would be you would buy in the one market and sell on the other simultaneously. And thereby, in theory, you would not have a great risk, because if I'm buying it for $1 and selling it for $1.10, I made 10 cents. That would be the idea. But it's a little bit more complicated than that, because unless we're talking about things operating in the same market, if we're doing this internationally, they could be settling in different currencies, right? Trading in different currencies and settling in different currencies. So in this case, let's say we're dealing with an asset that is selling in the US market, settling in the US market in dollars, and in London it's settling in the Great British pounds. Also, each market has their own rules, regulations, taxes, stamp duties, and fees or commissions, right? So even if you're comparing both in the US market, where you're comparing an exchange to an ECN, you'd have to normalize the price against any fees or other considerations between the two. But the idea here would be if you, oh, by the way, the third point here is that exchange rates are constantly in motion, right? So, you know, the pound to the dollar, the exchange rate is constantly changing, right? So if you're buying on the U.S. market and selling on the UK market, right? And you're buying in dollars and you're selling in pounds, you would have to not only take in consideration the taxes, fees, commissions, and stamp duties in each in those local markets, but you'd also have to take into consideration the fluctuations in the exchange rate. Now, the exchange rate could be your friend. Your exchange rate could be what actually is creating the arbitrage situation. So there could be a situation where when you looked at the asset on the two markets and you looked at the currencies in the currency exchange and you factored in all the taxes, fees, commissions, stamp duties, and any other fees, where there could be a difference that would make it favorable to buy in the one market and sell simultaneously in the other. That would be a case where arbitrage could be appropriate. And I'm using the global example here because I think that's the most likely case where you're going to find an arbitrage opportunity. You're not going to really find much of an arbitrage opportunity in the US between exchanges and ECNs. It would be so difficult to find a situation that would that the individual investor could benefit from. But arbitrage today, what it requires is it requires access to very accurate, up-to-date current market data. So you need to know what the market data is. What is the current price, bid and offer, bid and ask? You need very, very accurate data. You also need accurate product indicative data to make sure that the product you're buying and the product you're selling are the same product. They're the same asset. You also need access to very quick execution of your orders. So let's say you do see an opportunity to where because of a price difference that or an exchange rate difference that you can buy in the one market and sell in the other simultaneously and realize a profit. Even if you found that, you have to have access to executions that can happen simultaneously. So if you do your buy and then you simultaneously do your order to sell, but your sell order goes and sits in a queue and doesn't execute for 20 minutes or 10 minutes or 2 minutes, you could be looking at a loss here. It could create a problem. So you have to have very quick executions. And the other thing is, I'm just saying this, is you need powerful computers and excellent software to be able to make this work. So this is not something that's easy to do today, right? This is not for the average investor. Arbitrage has its own risks and is really something that happens for institutional investing. And it's done by technology. That's where we are today. But the concept of buying in one market and selling in the other, that's the idea behind arbitrage. I hope that explains the term. And if you have any questions, please feel free to contact me. Thank you, and have a nice day.